You might think the biggest threat to your portfolio right now is sitting in Washington, D.C., or maybe a tech bubble in Silicon Valley. You'd be wrong. The single most dangerous variable in the global economy, the thing that decides if your 401k retires you early or forces you to work until you're 80, is currently unfolding 6,000 miles away in Tokyo. We need to talk about what happened today, Friday, January 23, 2026. While Americans were sleeping, the Bank of Japan, the central bank of the world's third largest economy, pulled a move that has Wall Street sweating bullets. On paper, it looks boring. They held interest rates steady at 0.75%. But if you look under the hood, we are witnessing a three-way collision between a central bank desperate to kill inflation, a prime minister trying to buy an election with tax cuts, and a currency market that is breaking down. Why does this matter to you in New York, London, or Toronto? Because for the last 30 years, Japan has been the world's ATM. They printed cheap money, and Wall Street borrowed it to buy everything: your tech stocks, your real estate, your corporate bonds. This is the yen carry trade. Now, that ATM is glitching. The machine is threatening to shut off. And if the Bank of Japan mishandles this next phase, we aren't just looking at a Japanese recession. We are looking at a global liquidity shock that makes 2008 look like a dress rehearsal. Today, the yen cracked. The algorithms went crazy. And the Japanese government is playing a dangerous game of chicken with the bond market. Buckle up. We need to peel back the layers of this disaster before it hits your wallet. Let's get into the specifics of what actually went down today in Tokyo. Governor Kazuo Ueda, the man currently holding the detonator to the global financial system, announced that the BOJ is keeping the policy rate at 0.75%. Now, to an American used to rates fluctuating between 4% and 5%, 0.75% sounds like a joke. It sounds like free money. But you have to understand the context. For Japan, this is the highest borrowing cost they've seen in 3 decades. Since 1995, Japan has been in a coma of deflation. Now, they are waking up, and the transition is violent. The market calls today's decision a hawkish hold. What does that mean? It means they didn't pull the trigger today, but they are loading the gun for April. In the official statement, the BOJ revised their inflation forecasts upward. They admitted that the price of goods is rising faster than they liked. And crucially, there was a dissenter. A board member named Hajime Takata voted to hike rates immediately. When you have dissent inside a Japanese institution, which usually values harmony and unanimous decisions above all else, that is a massive signal. It's like seeing a crack in the windshield of a speeding car. It tells us that the pressure inside the BOJ is building to a breaking point. Ueda is trying to play it cool. He said, April is a month where there's relatively high numbers of price revisions. Translation: we are coming for your cheap leverage in the spring. Why didn't they hike today? Because they are terrified. They raised rates in December, just last month, and they are still waiting to see if the Japanese economy collapses because of it. They are trying to thread a needle during an earthquake. But here is where the story gets weird. Immediately after Ueda started speaking, the Japanese yen tanked. It slid to 159.23 against the US dollar. Traders heard no hike today and immediately sold yen to buy dollars. This is the knee-jerk reaction of the algorithm. But then, out of nowhere, the yen ripped higher. It surged from 159 to 157 in a heartbeat. That is a massive move for a major currency. It wasn't natural. It looked like a hand reaching down from the heavens to slap the market in the face. Was it the Ministry of Finance intervening? Was it a fat finger trade? Or was it just jittery investors realizing that the BOJ is actually trapped? Finance Minister Satsuki Katayama isn't saying. When reporters asked her if the government manipulated the currency today, she refused to answer. That silence is intentional. It's psychological warfare. They want speculators to be afraid. But fear breeds volatility. And volatility is the enemy of your stock portfolio. To understand why this is so dangerous for the US economy, we have to look at the politics. Japan is in the middle of a massive political gamble. Prime Minister Takaichi has just dissolved parliament. She's calling a snap election. She wants to secure her power base. But how do you win an election when inflation is eating your voters' paychecks? You promise them free money. Takaichi has pledged to suspend the sales tax on food. She's pushing a stimulus package worth 17.7 trillion yen, that's about 112 billion US dollars. She's trying to lower utility bills, gas prices, and put cash in pockets. Here is the problem: this is economics 101. If the central bank is trying to cool down the economy by raising rates, but the prime minister is trying to heat up the economy by cutting taxes and spending money, you get a collision. Does this sound familiar? It should. Go back to September 2022. The United Kingdom. Prime Minister Liz Truss announced a massive package of unfunded tax cuts at a time when inflation was high. What happened? The British bond market imploded. The pound crashed. Pension funds almost went insolvent. The Bank of England had to step in with an emergency bailout to stop the entire UK financial system from melting down. Liz Truss lasted 49 days in office. We are seeing the shadows of a Liz Truss moment forming in Japan right now. PM Takaichi is stepping on the gas pedal while Governor Ueda is stepping on the brakes. The car is going to spin out. When Takaichi announced her tax plan, Japanese bond yields spiked to multi-decade highs. Investors are terrified that Japan is going to print more debt to fund these tax cuts. Why should a guy in Ohio care about Japanese bond yields? Because of the widowmaker trade. Shorting Japanese bonds has been called the widowmaker for years because the BOJ always controlled the price. But if the BOJ loses control because the politicians are spending too much money, yields go up. When Japanese yields go up, Japanese money comes home. Japanese investors own trillions of dollars of foreign assets. They own US treasuries. They own Australian bonds. They own French real estate. They own stocks in the S&P 500. If they can suddenly get a decent, safe return in Japan without the currency risk, they will sell their US assets and move the money back to Tokyo. This is the great repatriation. If that happens, who buys US debt? Who buys US stocks? Liquidity dries up. US interest rates rise to attract buyers. Mortgage rates in the US go up. Stock PE ratios compress. This political gambit by Takaichi isn't just local politics, it's a threat to global asset prices. We need to go deeper into the mechanics of why the yen matters to the S&P 500. I mentioned the carry trade earlier. Let's explain exactly how this works, because it's the engine room of the current stock market bubble. For years, interest rates in Japan were 0% or even negative. So, if you are a global hedge fund, here is the playbook. You borrow 1 billion yen from a Japanese bank at 0.1% interest. You convert that yen into US dollars. You use those dollars to buy US Treasury bonds paying 4.5%, or you buy Nvidia, or Microsoft, or Bitcoin. You pocket the difference. It's effectively free money. You are getting paid to borrow. This trade has pumped trillions of dollars into global markets. It suppresses volatility. It inflates asset prices. But this trade relies on two things. 1. Japanese interest rates staying low. 2. The yen staying weak. If the yen gets stronger, you get squeezed. Let's say you borrowed yen when it was 160 to the dollar. If the yen strengthens to 140, you suddenly owe way more money in dollar terms to pay back that loan. And if the interest rate on that loan goes from 0.1% to 0.75% or 1%, your profit margin evaporates. When this trade turns sour, it doesn't happen slowly. It happens all at once. Everybody rushes for the exit. They sell their US stocks to buy back yen to pay off their loans. We saw a preview of this in August 2024. Remember that flash crash? The VIX spiked, stocks tanked. That was a mini unwind of the yen carry trade. Today's news, that inflation is sticky, that food prices are up 5.1% in Japan, that the BOJ is looking at April for another hike, means the unwind is coming back. Governor Ueda said today, inflation has been rising overall, we need to pay close attention even to relatively small movements in the yen. He is telling you explicitly, the days of the cheap yen are ending. Wall Street is currently pricing in a Goldilocks scenario where the US cuts rates and Japan hikes slowly. But with Takaichi's election spending, Japan might have to hike fast. If Japan hikes fast, the carry trade blows up. And if the carry trade blows up, there is a massive air pocket beneath the US stock market. Let's step away from the high finance for a second and look at the real economy, because this drives the politics. Why is Prime Minister Takaichi panicking? Why is she calling a snap election and promising tax cuts? Because the Japanese consumer is getting crushed. And a crushed consumer is an angry voter. The data released today is brutal. Food prices in Japan rose 5.1% in December. For a country used to prices falling for 30 years, this is a psychological shock. Imagine living in a world where a bowl of ramen cost 800 yen for 20 years. Suddenly, it's 1,000 yen. Then 1,100. But your salary hasn't moved. This is the cost of living crunch in Tokyo. The weak yen is great for Toyota and Sony because it makes their exports cheap. But it is a nightmare for regular people because Japan imports almost all its energy and a huge amount of its food. When the yen is weak, the price of gasoline, wheat, and beef skyrockets. So, the government is trapped. Option A, let the BOJ hike rates aggressively to strengthen the yen and lower import prices. Risk, this crashes the stock market and bankrupts zombie companies that rely on cheap debt. Option B, keep rates low to protect the economy. Risk, the yen collapses further, import inflation spirals out of control, and the voters revolt. Takaichi is trying to choose option C, spend government money to subsidize the voters while bullying the central bank to keep rates manageable. But as we discussed with the Liz Truss example, option C is the most dangerous of all. It invites the bond vigilantes. The bond market is looking at Japan's debt to GDP ratio and asking, how are you going to pay for this 5 trillion yen tax cut? If the market decides Japan can't pay, they sell Japanese bonds. Yields spike. The BOJ is forced to print money to buy the bonds to keep yields down. That printing weakens the yen even more. It's a doom loop. And right now, the algorithms don't know what to do. That's why we saw that crazy price action today, 159 to 157 and back to 158. The market is confused. And a confused market is a dangerous market. So, what happens next? As we look toward the April BOJ meeting and the Japanese election, we need to game out the scenarios. How does this impact your money? Scenario 1, the soft landing. Takaichi wins the election but scales back her tax cuts. The US Federal Reserve manages to cut rates gently. The gap between US and Japanese rates narrows naturally. The yen strengthens slowly to 145. Result, US stocks stay flat or rise slightly. The carry trade unwinds slowly, without a crash. Your move, stay the course, keep diversified. Scenario 2, the hawkish surprise. Inflation in Japan keeps heating up. The Shinto results in massive pay raises for Japanese workers. The BOJ is forced to hike rates to 1% or 1.25% faster than expected. Result, the yen rockets up. The carry trade implodes. US tech stocks take a 10 to 15% hit as liquidity is sucked back to Tokyo. Your move, have cash on the sidelines. This will be a buying opportunity, but it will be painful first. Scenario 3, the fiscal crisis. Takaichi goes full populist. She passes massive spending bills. The bond market revolts. The BOJ loses control of the yield curve. The yen crashes to 170, forcing an emergency, massive rate hike to defend the currency. Result, global margin call. A credit event in the US. Treasury yields spike, crashing the housing market. Your move, defensive assets. Gold, commodities, maybe even short-term treasuries. We are currently trending toward scenario 2 or 3. Governor Ueda's comments today about nimble operations to smooth volatility suggest he knows the bond market is fragile. He said, in a situation that's different from usual, we could conduct nimble operations. Different from usual is central bank code for crisis mode. The fact that the BOJ removed the language about needing to watch the outlook without any preconceptions suggests they have made up their minds. They are hiking. The only question is when, and how much damage it will do. And don't forget the US tariffs. The input mentioned that the negative impact of US tariffs is receding. This gives Japan more confidence to hike. They aren't as afraid of a trade war as they were a year ago. That removes one of the last barriers to raising rates. We often talk about the global economy as if countries are islands. We think what happens in Tokyo stays in Tokyo. But in the modern financial system, money is fluid. It flows to where it is treated best. For 30 years, money has flowed out of Japan because it was treated poorly there. That money built condos in Toronto, funded startups in San Francisco, and bought bonds in London. Now, for the first time in a generation, Japan is trying to bring that money home. Today's decision to hold rates at 0.75% was not a pause. It was a deep breath before the plunge. The upward revision of inflation forecasts, the dissenting vote, the political chaos with the Prime Minister's tax cuts, all of it points to a massive shift in the tides of global capital. If you are heavily invested in the US market, you need to watch the US dollar to Japanese yen exchange rate. It is the most important chart in the world right now. If the yen breaks 150 and heads toward 140 rapidly, look out below. The Bank of Japan is no longer the predictable, boring central bank of the past. They are fighting for the survival of their currency and the stability of their economy. And in that fight, your portfolio might just be collateral damage. Do not ignore the signals from the east. The butterfly has flapped its wings in Tokyo. We are just waiting for the hurricane to hit New York. Thanks for watching. If you want to understand how to hedge against a currency crisis, check out my video on hard assets right here. And as always, watch your 6, and I'll see you in the next one.